Good afternoon, and thank you for joining our webcast today that will examine the developments of post-trade in Asia. My name is Steve Edge, principal of AsiaETrading.com. The increasing focus on the post-trade is a culmination of factors, really, but before we look at those factors, we should introduce our very knowledgeable industry experts who will lend insight into this conversation. First, we have John Warren, Head of Post-Trade and Corporate Actions Asia, SunGard Capital Markets. Simona Cantanescu, Post-Trade Markets APAC at SWIFT, and Barnaby Nelson, Head of Client Development Asia, BNP Paribas Securities. Welcome, panelists, and thanks for joining us today.
Hello, Steve. Thanks for having us.
Pleased to be here, Steve.
Steve, how are you?
Well, before we begin, just some housekeeping first. The webcast is scheduled to run for 45 minutes with a 40-minute discussion from our panelists, and the last 5 minutes will be set aside for Q&A. We would like to encourage all participants to ask questions throughout the discussion using the chat feature. We will answer as many questions as we can. However, any unanswered questions will receive follow-up after the broadcast. You can also use the chat feature to communicate with us if you're having problems with the sound or picture, and we will do our best to correct it. Just to note, though, that the comments offered by the panelists are their own opinion and do not necessarily reflect those of the firm or company they represent. Global regulatory policy in MIFID and Dodd-Frank are mandating transparency, reporting, and agile risk management. Cross-border clearing and settlement add another layer of complexity in Asia, where regulations are not homogenous, but look to implement best practices found in the West. Silos are coming down, where a holistic view of trading operations and the firm's exposure to its counterparties are expensive to implement and challenging to deliver. But what is the current state of post-trade in Asia? How are these challenges being addressed? What are the real impact of extraterritorial regulation in Asia? Is STP a reality or just something that we keep talking about? Well, let's ask our panelists as we attempt to get ahead of the post-trade curve. So, John, I want to start with you. Just in a broad strokes, where do you see Asia standing along the post-trade curve?
Thank you, Steve. Look, I think it's a question that can't be answered in a single manner. From my perspective, I would say that Asia has a little bit of everything. There's certainly areas that we would generally describe as in the legacy phase. A lot of that is obviously imported from international organizations in the past. A large portion of Asia is very, very new to the post-trade market and has a very low level of capacity in the post-trade space on a region-by-region basis. And also within Asia, and I think where Asia tends to differentiate itself a little bit from the European and the US market, we're seeing more and more of the firms looking to get ahead of the curve and on a systemic basis and really starting to make decisions that will prepare them for the cross-asset nature of services that is a growing trend within Asia. So the answer is it's ahead, it's behind, it's in the middle. I tend to think that the trend within Asia is really to climb ahead of a curve that was developed by other regions. And that's certainly what we are seeing and discussing with many clients of SunGard.
Okay, thanks, John. Simona, let me ask you, as a SWIFT, working for SWIFT in the messaging space, where do you think Asia stands along the post-trade curve?
Well, I have a European background, and what I see in Asia is basically a high degree of diversity across post-trade environments in Asia. So from where I stand, it's quite a fragmented space. It varies from country to country. And I could mention here a couple of dimensions that introduce this diversity in Asia, which is so specific to Asia. One would be the domestic standards. So we see a number of countries like Korea, Vietnam, they promote their own local guidelines in the post-trade space. And that makes it quite difficult, if not impossible, to have a uniform approach across Asia and globally as well. Another dimension is these domestic regulations that get in the picture now, which you mentioned at the beginning. So we see major financial centers like Korea, Hong Kong that align to Europe. They are promoting T+2 settlement, while Singapore, China, they are in favor of T+3. And from a reporting point of view, there are differences as well. So Singapore is single-side reporting, while Hong Kong, they are starting to mandate dual reporting. That means both parts of the trade should report. And I would also mention, in addition to that, is the stage of development of each market infrastructure in each country. So there are countries that have well-established market infrastructures in the security space, like CCPs, CSDs. But there are also a number of countries that are at the stage of implementing these market infrastructures. And more than these, other countries, they are now establishing their payment systems, so the RTGS system. So I think it varies from country to country, and it's quite difficult to compare with the rest of the world.
Thanks, Simona. Barnaby, how do you see it, particularly in the security services side?
Yeah, I'd obviously, I think it's a bit of the standard answer is always the multi-tier kind of approach to Asia, in terms of the fact that we have the fast stream markets like Singapore, Hong Kong, Australia, Japan, and then you've kind of got the others. But I think to John's point, my strongest feeling is that we are this whole spirit of getting ahead of the curve. I'm quite optimistic, actually. I'm quite positive about how we stand in the post-trade space in Asia for a couple of reasons. One is that the banks in Asia, alongside market associations and vendors, have historically always been quite comfortable making up for the diversity of the region in terms of post-trade space. So, the big clearing and custodian banks and prime brokerages have always kind of assumed it upon themselves to largely to bring consistency to market practice and to connectivity when there isn't any at an exchange and market level. So I think that's always kind of laid a good foundation for them. It's made it easier for investors to trade in Asia, I think, historically. But I think the great thing is you start with that, and you've got the fact that basically that we're not in Asia kind of trying to react to the really excessive weight of domestic and regional regulation. We have a lot of regulation, both regional and global, but there is a strong sense that we are, we're not necessarily struggling, I don't think, to the same degree as those in the Americas and in Europe in terms of the amount of regulation that we have to deal with every day. It's probably a bit contentious whether we've got more or less, but I personally feel that we've got less, and therefore we're able, as John says, to be looking at moving ahead along the curve slightly. One of the things that we've always maintained as a clearer in Asia is, we've been sponsoring the cause or championing the cause for many years in terms of outsourcing clearing, and I think a couple of years ago I remember saying that Asia was, broadly speaking, about 10 years behind Europe in the kind of post-trade outsourcing space of clearing and settlements. I'd honestly say that we're traveling much faster now than anywhere else in the world in terms of market developments, to the point where I think we're catching up very quickly in terms of the usage and the understanding of all of the solutions out there that help to optimize liquidity, help to minimize risk and all that kind of thing. So I think we're a little bit more free to deal with these things. We're naturally innovative in the region. We've got banks and associations that are keen to help. And ultimately, I think all of that culminates in us traveling much faster along the curve.
Okay, thanks everyone. Interesting comment about the regulation, Barnaby. We'll touch on that later on in the discussion. But first of all, I want to go to the first poll of the technical problem here with the poll. It was basically, we asked what is the greatest post-trade challenge in Asia? Was it collateral requirements, cost of supporting the business, cross-border settlement, technology falls short, or trade breaks? We had a technical problem with the poll, so unfortunately we aren't able to share it with the audience. But let me move on to question 2. Simona, you touched on it a bit earlier. What are some of the challenges for Asia's post-trade space? And do you want to elaborate on that?
Sure, Steve. Well, I would say that there are the generic challenges that we see not only in Asia but across around the world. So mainly because the market is not what it used to be, right? We see a reduced transaction volume, and the challenge is obviously how to increase the margins when the revenue is dropping. And I heard specifically in Asia Pacific, I heard of an average of 50% reduction in margins over the last 5 years. So how do you address this, and how can a broker or investment manager still, in fact a broker, how can he still charge competitive fees when has such a drop in his revenues? And also linked to these reduced margins, there is a pressure to minimize operational costs, which is quite challenging now given the recent compliance requirements that Barnaby just mentioned. Now, going back to Asia, specific to Asia, I need to point again to this fragmentation of markets that's so typical in Asia, because this introduces a challenge as well, having different ways of operating the business and different market rules. I see now that a competitive Asian broker is required to support more than one market practice, because the buy-side community, for example, does not necessarily engage in following one standard. So most of the cost and challenge come from supporting different processes and different asset classes, or even from supporting the manual flow, which is still considerable in Asia.
Okay, thanks, Simone. John, what are you seeing as some of the challenges for Asia in the post-trade space?
I'd have to agree that from conversations, the most talked about challenge, I think, is on the margin side. The fees and commission structure of much of the industry is being squeezed probably about as much as it can, and that is looking to force people to look in other directions for a profitable business model. Perhaps leveraged more. We'll see more leveraged business being done. One of the things that I personally are concerned about is, and is not really discussed very much, it's the human capital side of things, and maybe the lack of experience for effectively a region that's relatively new is what's driving, to Barnaby's point, that the increase or the rapid upsurge that we're seeing in some of the outsourcing side. But while vendors, Sangard, outsourcers, providers can certainly ramp up their services, there's still going to be a certain amount of lag before the industry as a whole gains the number of experienced operators within it to truly pull ahead of that curve, and to wrap that up into Simona's point as well, with the number of various territories that we are operating in, whether that's a regulatory or a market environment, the expertise and the human capital, I think, is even more important than homogeneous areas of the Eurozone.
Okay, John, thanks, Barnaby. Any other challenges that you might see in Asia's post-trade space? Does it vary between firms, types of business?
Yeah, I mean, I think well, actually, just to follow on from John's point, actually, I mean, I couldn't agree more that basically that there is unfortunately still a very, very distinct divide between ultimately brokers, banks with headquarters in Asia versus those with headquarters overseas in terms of their approach to the problems that are coming up, and ultimately their approach to outsourcing as we see it. You know, I think to the human capital perspective, it's very true that there are those who have seen it work and seen kind of get it based on experience from overseas, and then I think unfortunately within Asia there's so much less precedent on the ground that people just don't necessarily, they don't intuitively buy it as much, and so the human capital in terms of understanding of how outsourcing and how the post-trade space can be simplified is just not there. The only other thing I'd say, and not surprising coming from a banker, but I mean ultimately what we've seen is a big change in the problems that people are facing in the last couple of years. I mean, I think to Simona's point, the last 2-3 years have been very, very much about cost cutting. I mean, we always say that, you know, if it wasn't firmly tied down, it's pretty much been thrown out by now. And you know, my sense is that was kind of the pure cost-cutting phase, more or less started coming to an end on the banking and brokerage side kind of towards the end of last year, where people had more or less gone for 2 years without good revenues and good margin, as Simona says, and as a result they'd pretty much got rid of everything. They'd done as much cost-cutting as they felt they could. And really this year we've seen a significant swing away from pure operational cost-cutting towards balance sheet optimization, and basically making sure that the cost of capital and the cost of, you know, of running a business from a liquidity perspective is now square and center. So in terms of the key challenge, we've seen it really moving from a, you know, they're all operational considerations, but from a real bums on seats approach to a much more of a liquidity and balance sheet prioritization.
Thanks, Barnaby. Well, we've heard cost-cutting and investment, John. I mean, where should post-trade investment be going? Are we seeing it moving from the front office to the back office, or is it still the same investment in the front? You know, where do you think investment should be made in the post-trade?
I'm going to answer most of the questions today with two answers. It would seem with the tremendous amount of regulatory change that's been forced on the markets in the last 3 to 4 years, there's been an increase in spending in the post-trade business that's related to the regulatory side of things. I think that has probably had a detrimental effect to spending in other areas of the post-trade business, and is creating from what I can see a little bit of a pent-up need to spend on post-trade processes going forward. We're starting to see that happening now, but that needs to be taken into context of Barnaby's comments, so that I think the overall spend from any organization in the last 2 years in Asia has probably reduced dramatically. But the post-trade area seems to be that the area that's attracting at least the thought of investment right now, rather than on the front end.
Thanks, John. Barnaby, do you agree?
I'll just add to that. I mean,
Please.
I think no, I was just going to say, I think ultimately, I mean, obviously OTC clearing is really the kind of is a huge, great umbrella that I'm surprised we've gone 20 minutes without actually using those two words yet. But I mean, that seems to be the umbrella that is driving so much of this investment in terms of, you know, the imminent kind of collateral crisis and all this kind of these scary things that we hear from Europe and America. I mean, that is hugely driving the focus in terms of investment in basically in proper liquidity management and proper operational management. And we see there's a survey that we do every year that we'll just be bringing out again next month, the kind of the Asian post-trade back office survey. And last year we from last year, where I think 55% of organizational resources amongst brokers and banks were being spent on either cost-cutting or regulation, we're seeing this year that that's even gone up. So you know, the trend is, you know, there is absolutely absolutely a trend towards investment in kind of post trades and liquidity, which is kind of going ahead of front office investment now. I mean, because it is so I think with the OTC kind of crisis looming, there is such a strong sense of imminent disaster that people kind of feel that all of this investment now is just to be able to survive for the next 5 years, and hence why it's getting good investment.
Okay, thanks, Barnaby. Well, let's just see how much investment is going on in the post-trade space. Here's our second poll, and hopefully it'll work this time. How much STP can be found in your office? So I'll just give the audience a few minutes to vote. The responses are none, faxes and spreadsheets, some but needs investment, mostly STP, completely STP, and not sure. Just give the audience another few seconds. 3, 2, 1. Okay, terrific. Let me just share the results to the audience. Interesting. 25% says some but needs investment, and 75% says mostly STP. Well, it seems like that investment has been going on, at least amongst our audience. But let me go to back to you again, John. Is that really the poll reflecting what we're seeing? Is STP a reality? Is it something that is achievable, or is it just something that we talk about and wish for?
I think it's a reality. It's an achievable goal. Sorry, I should say. At the moment, is it the focus of where people are looking? I tend to think that since the OTC word is now out of the bag, I think the OTC clearing and the drive for collateral optimization is probably pushing ahead of the traditional look at SDP. It's so much to the heart of the survival or profitability of a lot of organizations that I sense that STP would be a topic in 3 to 4 years once again, once some of the more important market changes and the collection of data needed for the market changes, like the aggregation of collateral has taken place within organizations.
Thanks, John. Barnaby, STP, is that a reality, or is it just another buzzword for the industry?
I think it probably depends on who you are. I think ultimately STP most people who aren't necessarily, a lot of people who connect to a custodian or who connect to who use various intermediary systems or people to connect to a marketplace. I think there's a lot of people in the market, all those people who are ultimately shielded from the direct complexities of the market. And I think my instant reaction is actually STP rates in Asia are very high, because there's a small number of people like ducks on water, kind of pedaling very hard to make sure that they protect their clients from the market connectivity piece. In terms of those who actually do connect to the CCPs, to the depositories, to the exchanges, obviously STP rates are going to go around, vary depending on the region. As I said, in terms of kind of tier 1, tier 2 markets, they're all improving, and some of them, ironically, like India, are ultimately at the head of the queue, really, in terms of levels of STP. But for me, I think the most important point, probably now to my point, are really about where we stand in the evolution in the last few years. Is I would tend to think that STP is now more or less as good as it's going to get. That there's, barring major market changes, the introduction of ISO 2022, that kind of thing in individual markets, from a practitioner perspective, there's not much more, I don't think, that practitioners feel they can do themselves to optimize STP. And for me, the KPI now is kind of swinging round away from necessarily STP rates to more, first of all, the cost of the trade, which is much more linked to the end-to-end process, including the market fees and all that kind of thing. And second of all, the liquidity impact of a trade, in terms of how much collateral does a trade cost or suck in, and what's the balance sheet impact. So I think for me, STP rates are they're pretty much where they need to be, and I think people are kind of starting to see beyond that. I'd like to think so anyway.
And Simona, I mean, you're coming from the European markets, how do you see STP shaping up in Asia?
Right. I think there can be improvement in STP because there's still lots of manual processes, faxes, emails that we see around. And there is a certain resistance to change this. But definitely we wish for STP, so we want to see it improving because it comes with standardization, with efficiency and all the desirable aspects that we want in post-trade. Now, I think the question is, do all firms have the capability or budget to automate and to reach STP? And here probably we need to look at the drivers of the market. And as was mentioned before by John, I think one promising driver is the regulation. So I say that STP will become a reality if the regulators want this. Because compliance is an incentive for firms to improve STP and to clean things up. Until this happens, I guess Asia will stay where it is now, as Barnaby said, which is an acceptable level of STP.
Okay, thanks, Simona. I think we've heard each one of you say regulation at some point in your comments, so we should probably address that. Let's keep with you, Simona. How do you see Dodd-Frank or MIFID affecting the post-trade space in Asia? Does the industry even care, or do they take it very seriously?
Well, they definitely care, and they are starting to take it seriously from what we've seen. Now, at the minimum for Asia, right, compliance comes first with the cost of evaluating all these new pieces of legislation. This is the first step that needs to be done in Asia. And it's quite time-consuming and costly because all these pieces of regulations are complex, they overlap, or sometimes they even conflict with each other. And once this evaluation is done, I guess there is a cost. There is an impact assessment cost, and eventually implementing and applying all the enhancements in the infrastructure in order to cope with these additional regulatory requirements. I think there are regulations like EMIR. I would mention EMIR, the European Market Infrastructure Regulation, which comes with the dual reporting requirements, and because Asian firms may trade with clients in Europe, they can be affected. So that means that both buy side and sell side might report in a trade, and if the client is based in Europe and the asset manager is in Asia, then there is a need to report in the context of EMIR. Now there is also, as was mentioned before, the collateral and the reporting to CCP requirements. So under EMIR, the non-European counterparties trading with a European counterparty will be obliged to clear trades via European CCP or a CCP which is authorized by EU. So this is another impact on the Asian players. And also for the OTC trades that are not cleared, then there is this need of daily portfolio evaluation, and we had a client mentioning it the other day as a challenge, really a headache, because these variation margins for uncleared swaps, they are more time consuming than the initial margins, so it comes as a challenge for them. And at the level of market infrastructure, I would say also that the CCPs and the trade repositories in these third countries in Asia wishing to service European-based entities will have to demonstrate that they go by the EU rules, and they need to apply to European authorities, to ESMA, for recognition. So there is, I would say, there is an impact in the Asian market as well.
Well, what do you say, Barnaby? I mean, certainly as a European bank dealing in Asia, your customers, your local customers must be asking questions or looking for some guidance. I mean, what's your view on the post-trade space in Asia and with regard to these regulations?
I think, I mean, on Dodd-Frank and EMIR, I probably won't go much beyond what Simone has outlined in terms of the regulations themselves, but what staggered me regularly is the reaction of Asian kind of participants. Just unfortunately, most of us are just hoping that the problem just goes away. I think, you know, I mean, from in the last 6 to 9 months, I mean, I've spoken with a number of exchanges, number of clearinghouses, number of market participants, and the general view, the level of sophistication of their understanding of some of these things is remarkably unsophisticated. And so I think, you know, I think ultimately there's a bit of a, I don't know whether there's a looming problem or not, but you know, I'm not sure that we all understand you know, the combined collective effects of Dodd-Frank and EMIR on each of our respective trading operations in Asia. To the degree that we can say, right, we know that we're okay for the next few years. I think there's as I said, there's a general feeling that European regulation impacts Europeans and American regulation impacts Americans. And of course, I mean, that's just not the case. So there's a little bit of a sense of kind of impending something, impending crisis, impending furious working to catch up, or hopefully something a bit better. The only other thing I'd say though is, I mean, for me, under the regulatory banner, the bigger one that actually whenever we speak to clients is interestingly is AML regulation. So you've got this kind of pincer effect at the moment between balance sheet and liquidity driven or liquidity impacting regulation and kind of know your client regulation, and we tend to find that the latter is actually more impactful for a lot of people we're speaking to at the moment, in terms of, you know, Hong Kong, Singapore, other regulators getting very, very much more stringent in terms of the documentation that we demand of clients. You know, the amount of information that has to be held, all the way through to obviously sales and distribution rules for private banks and distributors. So, for me, that piece around know your client is actually kind of, we overlook it, the Financial Times and everyone overlooks it because it tends to be at more of a local level. But in terms of impact on our daily lives, I think that one far outstrips any amount of preparation for Dodd-Frank, or work going on rather for Dodd-Frank, EMIR, and the OTC space.
Okay, Barnaby, thanks for that. John, what are you seeing? Dodd-Frank, MIFID, EMIR, SIFMA, FATCA, Basel III. It goes on and on. You know, is this affecting the post-trade space in Asia? Does anyone care or take it seriously?
I think the general impression, seriously is probably too strong a word, but it's not being taken seriously enough. I think, you know, Basel III, the same as Basel and Basel II, global. Global regulatory change, global measurement tool that really doesn't tend to disadvantage anybody. I think where you look separately at Dodd-Frank, EMIR, regulations, MIFID, the concern for Asia, as Barnaby was alluding to, is there's not an awful lot being done in response. And it is very much a case of acceptance at the moment from Asia. So to reinforce Simona's point, you know, there's more likelihood of double reporting, if not tri-reporting requirements in Asia, if there's not some type of regulation that allows Asia to operate within itself and not, you know, constantly be answering to CCPs everywhere else, or to have some type of agreement. I can't see any evidence of much of that happening at the moment. In fact, it seems to be that ring fencing on a national perspective is the answer that Asia has, which I think is going to increase the amount of complexity, and it's certainly not going to provide any clarity to you know, what the effects of Dodd-Frank reporting or EMIR are. So on the horizon, I see more complexity, generally from I think a lack of coordinated reaction within the region, contentious as that may be.
Well, let's see what the audience thinks on the global regulation affecting the local market with our last poll of the session. Are global regulations affecting your back office? So I'll give the audience a few seconds to vote. Not at all. I haven't checked. There is some impact. Yes, we can't keep up. Yes, but we are ready. We'll just give the audience a few more seconds to respond. Okay, 3, 2, 1. Thanks a lot, audience. Interesting results. 33% says there are some impact. There is some impact, excuse me. But 2/3 are saying, yes, we can't keep up. So it would seem there's a need to service the regulatory impacts of post-trade in Asia. Well, thanks a lot, audience, for your opinion. I just have one more question before we go to the Q&A. So, audience, if you got any questions you're holding back, now's the time to ask them into the chat feature, and we'll pass them on to the panelists. John, you touched on it briefly. You said something STP will come back again in 3 or 4 years. Let me ask you, what do you think the post-trade space will look like in 5 years?
That's the question, isn't it? I think that we will have an environment of far greater connectivity between asset classes in the post-trade space, undoubtedly. That's already being driven by the effects of having to aggregate collateral. So that I think is going to be the major change. I see a lot of the silos being removed in Asia, and that's really, we started the conversation before. I see Asia's ahead, or moving ahead of the game there with that. So my overriding vision of the post-trade space from Asia is a very tightly connected cross-asset offering at most of the tiers of operations and across the geographies.
Okay, Simona, what are you seeing as the futures post-trade in the next 5 years?
I fully agree with John on this. I think we are all going towards a holistic approach across post-trade, using the same system, same infrastructure for all asset classes. This is a painful point today. I mean, we've seen brokers using 5 systems or even more in their post-trade just because of different asset classes they are trading. So hopefully we'll go towards this holistic approach across asset classes. I think we're going to see a certain trend to reuse the existing technology also, which is in place already, because that comes with cost reduction. And as we discussed until now, development towards STP, but also, I would say, a common framework across countries, maybe for interoperability, regulations, clearing and settlement as well. So I would guess it's a fine-tuning of the existing status quo, but it's quite difficult to envisage a harmonization or an integration across Asia. Quite difficult to envisage that.
Yes, I would have to agree. What do you see, Barnaby, in your crystal ball looking 5 years ahead?
Based on the experience we've seen in the last 18 months, I would expect in 5 years' time, I'd expect the amount of outsourced clearing that's going on in Asia to be well over the 50% mark of any turnover across all asset classes. So not only derivatives where outsourced clearing is very established, but also fixed income in the OTC space, and most importantly in the cash equity space. I think at the moment outsourced clearing in that space is very small in a lot of Asian markets, but I expect that some of them, at the moment that's possible in 4 markets on the cash side. In Asia, I'd expect other markets like Malaysia, Thailand, Indonesia to catch up, so that ultimately, the basic point really being that financial market participants will outsource their balance sheet, their risk, and they will outsource their balance sheet requirements to banks. So it's returned to the old banking model, I think. But I really see that the outsourcing of clearing is going to be the next phase in the outsourcing space. I think, the last few years we've seen a growth in kind of software and system outsourcing. I think outsourcing liquidity and risk is going to be the next big thing. The other thing I would say is I genuinely think that in 5 years, I seriously hope that we have all gone a long way to outsourcing our AML, databases and our AML processes to the degree where, AML and KYC documentation and it becomes largely like static data is today, i.e. heavily commoditized and heavily standardized. At the moment, I think that's one of the biggest areas. Alongside liquidity, I think it's one of the biggest areas where we can make some very easy progress. I know there's a lot of work going on there, so I think it's realistic in 5 years to expect real progress to have been made there.
Okay, thanks everyone for your feedback. It's the Q&A session, so let's move into that. Here's a question from Matthew. Thanks, Matthew, for that. Do you foresee any new offshore centers emerging in Asia? I'll just leave that up to if anyone wants to jump in to respond.
Offshore center in what context? Just sorry, difficult to ask an anonymous panelist what context, but are we talking about India offshoring, operational offshore, or are we talking kind of banking offshoring as in Cayman style?
Good question. Maybe Matt will give us some more detail. Sorry?
Well, maybe I'll start with the first, maybe, and then we'll see if I was actually meant to be talking about the second one. I'd suggest that, at the end of the day, offshore centres like Chennai, Hyderabad, Pune, and all the rest of them are just going to multiply. Vietnam, Philippines, Cambodia has already been talked about. China is the sleeping giant for outsourcing and offshoring. I honestly, my sense on the offshoring question is that it's actually the model that's going to get very much more sophisticated in terms of selective offshoring to selective centres, to the point where it's actually a far more mobile process than it is today, where it's kind of more lock, stock, and barrel. So to that point, I'd see in the next 5 years, I'd probably see another. Well, I'd probably say that other than India, the other top 4 kind of outsourcing centres or offshoring centres are probably going to be ones that we've never even thought about today. Thanks,
Barnaby. Matt came back and said India, so I think you were spot on there.
Oh, there you go. Cool.
Does anyone else want to add to that, or shall we move on to the next? No? Okay.
No, I agree with Barnaby.
Oh, go ahead, John.
I was just saying I agree with Barnaby. I think it's going to increase, and we've got China, which is 70% population of Asia, not included even in the mix at the moment.
Okay, well, let's move on to the next question. This one probably goes to you, John. Does the need to align systems and the process with global regulations impact having efficiencies, break down back office silos, etc.?
Okay, I think there's probably 2 or 3 things there. I think, yes, the need to align systems definitely creates a need to relook at the operation, and therefore any operation, hopefully, its goal is to be efficient. So to relook at the operational efficiencies. To my point earlier on, my concern at the moment is that we're aligning ourselves, or people are looking at aligning themselves to regulatory changes that, if you assume for now that Asia has not really got any regulatory framework in place along the lines of Dodd-Frank or EMIR, are we aligning ourselves operationally and systemically to 2/3 of the answer? Yes, I think this is driving everything from choice of systems, how systems work, how the operational organization is structured, and in many cases breaking down the internal organization barriers that have existed from the original silos of markets.
Mm. Yeah, I'd just add to that actually. I mean, we did a survey when the Hong Kong clearinghouse changed their collateral requirements last year. The guarantee fund changed, and actually with Steve, we did a quick survey in terms of the number of people that were actually even kind of dealing with it from an operational side, in terms of just trying to work out how many operations people from COO, head of ops level, how many people were even aware of or dealing with basically a treasury problem. And it was fascinating actually that we asked the same question again this year, and the progress that's been made is huge in terms of the alignment, more on a people basis than on a software basis, but on a people basis between operations and treasury. People are much better across the market, certainly in the major centres in Asia, at being able to see both sides of the fence in terms of what being able to see the implications of any given issue from a liquidity and an operational perspective. It's one of the biggest developments we've seen in the last 12 months, I'd say.
Interesting. Okay, well, Simona, do you have anything to add, or shall we just move on?
Well, on this regulation subject, I would say that addressing the compliance requirements, as was mentioned until now, might have a negative impact on the current systems in an institution. Because if an institution has an established, well-functioning post-trade system, introducing this new component to designate it to meet compliance requirements may decrease the overall efficiency of the system and may impact the automation, may harm the holistic approach that probably was achieved so far. So
okay.
I think that would be an of regulation. Yeah. Okay,
interesting insights. We're out of time, though. It's already 3:48 according to my watch. So I'd like to thank John, Simona, Barnaby for their time and insights on post-trade in Asia. I certainly learned a thing or two, and I hope our audience has as well. Thanks, guys.
Thank you, Steve.
Thank you, Steve.
Just for your information, this webcast has been recorded and can be heard again by visiting asiaetrading.com/webcasts. Well, that concludes our webcast today. If you have any further questions, please contact me, Steve Edge, at support@asiaetrading.com. Thank you all for attending an Asia E-Trading webcast and hope to see you again soon.